Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, July 12th, 2024. It's 12:14 p.m. Eastern Time, so I'm starting the video, and this is actually video number 3 for the day. And I wouldn't be surprised if I put another one out there. When opportunities increase, so will the rate of my updates, posts, trade ideas. So the last video I got out to you, I just published, was on recreational vehicles. Those were long trade ideas. I told you I'm to work hard to share both, and I have been. I've focused in recent weeks, even recent months. I highlighted an update on Intel yesterday. Did the home builders. Mentioned that as a long, and so I've been highlighting, and even the ones that I've been short or bearish on, such as Nvidia. I've highlighted multiple long entries there, including and not limited to the pullback to the trend line yesterday, which was good for into the highs today, a couple percentage point bounce. So again, so I'm going to continue to pump out analysis, trade ideas. This video, I want to concentrate on the retail sector. Because I think it's, first of all, trade ideas, first and foremost, and very, very important to the economy, because right now, I'm going to talk a little bit about fundamentals in this video before I get to that. I'm going to start out with QQQ, only because there was a comment I saw on the homepage just before putting this post out there, where someone kind of a rant on like, oh my God, this is the most bullish candle that we've ever seen in years, and QQQ since like the .com bubble. No, and I said this yesterday. Yesterday's move in QQQ, although it was outright certainly a bearish engulfing candle at the end of an extended uptrend with divergences, low volume sell signal indicators that I've had. Everything else, yeah, that I view as bearish, absolutely, unless taken out. So, however, the move down was nothing. As I mentioned, it was only down, I think the Qs were down about 2.3. They were maybe a little higher from the lows, but it's just over 2%. There's plenty of that. I just want to say, so from that aspect, it wasn't anything more than just a profit-taking day, a run-of-the-mill. It was the biggest drop in a while. So, guys, don't fall prey to recency bias. It's one of the the big biases in trading stocks and all that, to think that, just what's going on recent, we've had low volatility, relatively low volatility, a steady walk up, but I expect volatility to expand. That's why I threw the VIX out there as a trade idea yesterday. And I think yesterday was, probably the, shot across the bow. We'll see. What I can tell you definitively so far, we stopped, that bullish falling wedge on the 5-minute chart at uppermost of the 3 targets at 497.50ish. Let's cap the rally right now, and we'll see where we go from there. This is my 60-minute chart. You can see I have the level turned down, but there's another alternative trend line right here. I'm going to turn it up a little thicker for you. So that's one to watch. That's pretty much comes in at yesterday's lows, which again was support on the, as I showed you on the 15-minute chart yesterday, this support right here where I covered the shorts and flipped along. So that's the level where that trend line comes in. I wanted to point that out. Remember, this bearish pennant never materialized, so I'll take this measured target. Not that we can't go there, but it's nothing to do with that's not a bearish pennant anymore because it never triggered an entry with a breakdown. So I wanted to do that update for you. And on that, now going back to, there was another comment, that's right, another comment about small caps. Somebody, when I was doing the last video, somebody said, small caps are breaking out, Randy. And then somebody else said, let me see what, I can't find that, but either way, the comment, and the small caps have been rallying. Believe me, they've certainly been rallying the last few days, and I have virtually zero doubt that it's been based on the comments that have been coming out of the media that we know a rate hike is now. The probability is very high. Last I checked, it was like 80% for a cut at one of the upcoming meetings. So we're going to get a cut. I've been saying it all along since the beginning of the year. The Fed will cut rates this year, but they're going to cut rates for not. Guys, I mean, it's crazy. I've done this so long, and it's the same pattern. And I'm going to say this is going to sound a little offensive, but the general public, even a lot of the pros on Wall Street, are just kind of dumb. They don't get it. Okay, so rate cuts are bullish, and small caps. Randy, you've said it yourself. They're the most rate sensitive of all sectors out there because they're dependent on borrowing costs, unlike the large caps, which are largely self-sufficient. Yeah, but do you understand the bigger picture here? The bigger picture, the macro is this, and I've covered this in the past, and I encourage you to pull this. This comes off a site called macrotrends.net, and what you're looking at here, plain and simple, is the history of the federal funds rate. And what we know, what those of us have been doing this, and you've heard me cover this. Um, there's the Fed is always has been and are predictably behind the curve. They're reactionary, not proactive. And so you go through rate hiking cycles. If you can make it out in the video, if you can't, you need to either not watch it on a phone or turn the brightness up on your monitor. I can't increase these shaded areas. I'm putting arrows at each one, including this, are recessions. Okay. And with recessions, as we know, come bear markets. This is the 70s was a vicious one. We had rising rates, inflation, and one of the worst bear markets there. You had the dot-com bubble burst right there. The NASDAQ fell 78% from the 2000 peak during that recession. This is when the S&P and NASDAQ both fell about 56% during the Great Recession. Again, off these recessionary periods. But what is nearly immutable and very predictable is the fact that we have a rate hiking cycle, and the economy and the stock market continues to go. The Fed is raising rates because things are doing well. The economy is doing well, and they're trying to prevent inflation from rearing its ugly head. But history shows, and I'll show you again here, that what happens is when they finally go from a rate hiking cycle, it usually plateaus first. You can see we just plateaued right here, right? We plateaued there. We plateaued there. We plateaued here for a little while. Sometimes it's a sudden pivot like it was right there. But invariably, the cuts start and then the recession follows. So contrary to the, what's happening right now, people buying small caps thinking, okay, now finally Powell's going to cut. He's only going to cut because the Fed sees an inevitable slowdown in the economy, and that is net bearish for the stock market. And so now this is not a timing indicator, because in this case, the turn was right here, and boom, the recession followed. This case plateaued. They started cutting right as the recession started. And remember, please remember this, recessions are always declared in hindsight. The NBER, who is the agency that declares recessions, recessions defined as 2 quarters. Well, it's actually, their definition is arbitrary. They can use whatever they want and quantify something as a recession or not qualify it. But then they always declare it in hindsight. The historical definition has been 2 consecutive quarters of declining GDP growth. And that's usually what you get with the NEBR. National Bureau of Economic Research. Yeah, NBER. I said it right the first time. So there's the peak right there, and then they started cutting, and then you can see the recession followed. There's the peak. Then they started cutting. The recession followed. That was when, and this is what's going to happen this time. That was the 70s. They had inflation started rocketing as they were raising rates. They saw then what the effect of the raising rates were doing to the economy. You're getting some stagflation. The economy was weak, but they started cutting, and inflation continued to surge. So they had to cut again. That's the federal fund rate going up. That's why the recession persisted. I wouldn't be surprised to see something similar this time around, right? But again, peak in rates, recession. It cleared, another recession, another peak in rates. They started cutting right before the big recession in the 80s. They peaked here, we're going down, but then the recession came. That was the early 90s. Peak was right here. They started cutting, then the recession followed, and the big bear market, again, 78% drop, almost 80% in the NASDAQ. S&P was less because the bubble was in the NASDAQ, just like the bubble's in AI now. And then there's a cut there. So, all right, hopefully I've driven my point home, is that take advantage. Now, look, you don't want to step in front of a rolling. I'll dig deeper into the small caps and let you know when I think I'll try to maybe do the same thing if I can predict kind of a top end range for the small caps. But they're gonna, for a greater or lesser part, they'll follow the big caps if the big caps peak out here soon. And again, I just wanted to drive home the point that rate cuts are in my view based on statistics. past. And we're not talking one cycle. We're talking every rate hiking cycle followed by the turn. Then comes a recession. So I'm not viewing that as bullish as it's being spun on the media, or at least people don't know this. And so they're buying, they hear small caps are rate sensitive. They're buying small caps. The algos jump on that trade. And so just be careful of the small caps. That's what I'm saying, because they are the most rate sensitive, but they're also economically sensitive as well. And so this indicates that if things were hunky dory, the Fed wouldn't be cutting rates, and it's almost, again, you can almost bank on it, because looking at the other turns, if we do see a turn in this rate cycle. Oh, by the way, guys, I didn't cue it up. Same thing holds true to the yield curve inversion. It has been infallible. It's about the one I talk about. No indicator has been 100% effective. It has. It's predicted. I think, what's the record? 7 of the last 7 recessions with an inverted yield curve. But hugely important, yield curve's been inverted for a while now. I didn't cue that chart up, so I don't have it here, but it has always been the reversion, what they call the uninversion of the yield curve, and we've been inverted for an abnormally long period of time. So here, let me see if I can grab it for you. Okay, here they are. This site's called Guru Focus, Guru focus.com. And here's the yield curve that you can, again, hopefully you can see it on your monitors. If not, I can't fix that. I can't make these recessions any brighter. I'm going to zoom in. This is the 10 to 1 year Treasury yield curve, and this is the 10 to 2. And you can see on both of them, the recessions are marked in gray. And so you get the inversion comes first, all right? You invert first, inversion, recession. Another inversion here, recession, or that was the one in the same with back-to-back recessions. Inversion, and it's the uninversion. When you cross back above the zero line, that's when the yield curve is no longer inverted. Then the recession invariably, let me say this again, invariably with zero exceptions has followed. So that's what we're looking at now. There was the last inversion followed by the uninversion, and then that COVID was a recession. The lines there was skinny. It was what I call Ursa interruptus, a bear market. It would have been a worse recession, obviously, but we've seen not even a close second the amount of fiscal and monetary stimulus injected in the markets, but yet we still got the recession. So that makes this thing 100% track record. But again, study this on your own and just know that. So, and this is just the cycle. It's predictive. It's the human psychology. They, folks, put so much into the Fed, and they think the rate cuts are going to, make the economy go, avoid any recession. Stock market go a lot higher from there. It's almost, again, maybe this thing goes now and it misses this time around. We uninvert, but then we don't get a recession imminently. Imminent, when you're talking a scale of here, this is imminent would be within, I would say, certainly within a year, more likely probably within 6 months once we get the uninversion. And again, remember, they're not going to tell you on CNBC, because the recession, they've got to wait for quarterly GDP to come out. Every quarter when they release it, it's already 1 month behind the lag time to release the previous quarter's GDP. So that's data that's as old as 4 months old, from last 4 to, month prior. Over that period. So just food for thought, guys. I'm just trying to factor in these fundamentals that do matter in the bigger picture. They just take a while to play out, and they have to get the signals. So I talked about this as many others. We inverted way back here, and this is one of the most prolonged inversions. It's the closest thing we had, at least previously, was right there in the early 80s, and then this one is really very similar in the 70s. It's also the most similar macro environment with the runaway inflation. And same thing for those that believe that the business cycle has been repealed, or that believe the lag effect doesn't matter anymore. This was the most aggressive hike going back pretty much, at least if in modern history, in decades. And the lag effect will matter. It's just taken longer for reasons that I've stated, and others that, we had that extended period of artificially low, zero interest rates from the Fed after when COVID hit, up until that point, up until recently. So a lot of corporations and individuals locked in at uber low rates. But it's the corporations, some of us locked in on 30-year mortgages at 2.5 to 3%, 3.5. But most corporate debt will be coming due by the end of this year and next. There's a mountain of debt coming due. And so that's, again, I'm kind of going off on an economic macro tangent here. Hopefully I'll get to the retail sector in this video, but then you have my IEF chart, which with my zones, which oh no, it's a 60-minute. Here we go. These zones I've been giving you for many months now. Yellow zone right here, orange zone, red zone. But as I mentioned all along, it's not as much, especially at this point anymore, simply how deep we are into these zones. It's also a function of time, because as time goes on, more and more companies, it didn't matter to, let's say, XYZ Corp. Even if we got in the red zone, which means yields are going up. Remember, bond prices are falling, yields are really high. That would have taken out the multi-year highs right here in yields, which is a multi-year low in bonds. It wouldn't matter to XYZ company if yields went to 20, 25% on corporate debt, if they're locked in. It only matters when they have to refinance. So, and that's the thing. We knew a lot of companies were locked in, and those rates are now coming due. So if you flip it around, and I might just end this video here, just covering macro stuff, because this to me is important and it matters, and it always has mattered. And just because we've had a very resilient, an unusual, an unorthodox market, but this is the 10-year Treasury. When you look at it, and we can go back here, let's go to a weekly chart. Let's just turn off all the lines right here. So here we are. We're at yields now at levels not seen since back in the early 2000s. This is 2002 right here. You got 02, 03, 04, 05, 06. That's where, this is the area where yields were back then. And that was the great financial crisis. So we're back to that point. And so this is where a lot of corporations locked in at these super low rates, but they're coming due, and they're going to be rolling over from this to this. So their interest expense is going to go up significantly. And again, let me reiterate, no sector, no area of the market is impacted more than the small caps, because again, they're young or relatively smaller companies that are much more dependent on continually borrowing, meaning selling bonds, borrowing money to finance operations. So they're betting on this. The market, they're hearing the Fed's going to cut rates, but I also need to remind you, as I often do, that the Fed does not control this, not even close. This isn't the rate the Fed sets. They can't control this rate. Yellen's been trying her best to, issue. She's been issuing at the short end of the curve, or else the country would be bankrupt right now. Nobody's buying. They can't sell a lot of 10 and 30-year bonds anymore. So she's been issuing short-term maturity, Treasury notes, bills, 1 year or less. That's where most of the issuance has been. But either way, even then, these rates are set by market forces, not the Fed. The Fed controls that federal funds rate I showed you right here, not the rate on Treasury bonds. And so where I'm going with that is, it is completely possible to see the Fed cut, and they will cut, but yet to see bond long-term rates either stay where they are or even possibly go up if they think, again, what's going to make that happen? Fed cutting rates and long-term rates go up. One scenario, stagflation. This is a big part of it. USO, crude oil, not letting up, staying at its highs. This is where it started to matter back to the market. Remember, this is where the stock market peaked, right here in 2022. Crude kept going up. It didn't matter until it started to matter. This was one of the biggest drivers of inflation. And so crude prices remain elevated in that range, and they're at the upper end of that range there. So this would be net bullish for the stock market if crude went down. If it stays high or goes any higher, again, you also have my ranges on USO that will really impact the market. The only kind of caveat to that whole thing is if crude does this And it's because the economy really starts to show signs that it's decelerating and heading into recession. You could see demand destruction, and you could see oil fall and not have a beneficial impact to the economy. So, but this there's no two scenarios here. We go to the red zone. That is, I cannot spin that as any other way or see any other way that that's net bearish for the stock market due to the impact that crude oil has on everything from gasoline to energy prices to heating, cooling your home to manufacturing things to moving goods and services from on planes, trains, and automobiles and all that good stuff. Okay, I won't go through all the components XRT. I will do it in a separate video. I just want to keep this one. We're only at the 20-minute mark, but the big picture, this is the sector ETF XRT, and I've covered it quite a bit recently. We've had this trading range here, and if you're a glass half full kind of guy or gal, you'll say, you know, hey, breakout. But we've had one, two, three, multiple breakouts. So we keep falling back in the range. And I think ultimately we're going to go back down to the bottom of the range. In fact, I gave you back here. I first predicted if the breakout would fail. And I gave you this bearish rising wedge in which to trigger a short entry if you didn't want to just take it on faith that it would fail. And we hit my first target. I gave you one. T1 was hit right there. T2, T3 zone right here, and T4, which is the bottom of the range. So what happened since then? Well, kind of like the banks and the financials I showed you earlier, we had a breakdown and a solid sell signal back then. Nice trade, hit the first target as expected. We had a reaction. It's taken a little longer than I thought, but it's just a slight, ever so slight. It was a slightly marginal new high above there, and we've also went on to set up a secondary trend line or larger wedge right here with the same, comes off the same lows. Very well defined with a lot of reactions here recently, a recent breakdown and now a back test. And that's why I wanted to highlight this as an objective short entry today. So what I'm doing and I'll continue to do is give you longs for those who are bullish or those of you that are flexible traders like myself that can go long and short. And this one is a sector that I would look at as a short and it's objective. It's timely. That's why I wanted to do the video. And I was going to go through the all the names. I'll rifle through them, but I don't have time to spend on a lot. But there's Amazon. There's your trend line to break. There's your targets. I've covered this a lot lately. Walmart also, just the same story on most of them. Big divergent highs. That's why I think the downside, we're going to see a considerable downside in the Costco right on the trend line. Big reversal yesterday. Big divergent high. Big negative divergences. TJ Maxx divergent high. This one, Target, I would go long if anything. It's just coming off support, about 138 support, just broke out of a bullish falling wedge, but it's got resistance, first target here, then there. So again, you want to hedge up in the sector, short XRT or the individual names and go long. This one is an indirect hedge if you want. O'Reilly breakdown back test, so that one's going lower. Ross Stores, ROST, big divergent high. AutoZone needs to break that trend line, already peaked on a divergent high. KR, Kroger, you can see the downtrend line. Dollar General, Tractor Supply just broke down, little snapback rally, so this one probably headed lower. eBay looking bearish to me. Carvana, beautiful little very well-defined trend line, in which I have a price alert on this one right here. There's your trend line, uptrend line. And that's it. I could go through them all. And I was going to do more of them in the video, but let me just throw that out there and kind of I'll get to it a little bit more and cull through all the components and share some of my favorites. The ones I went through are in order of market cap, so those are your bigger names, meaning they're more liquid. If you're short selling, ideally you want the more liquid stocks, or like I said, keep it very simple. XRT, you got a basket of all of them. It's offering an objective short entry here on a back test of the downtrend line with a stop. I'd just keep it a stop over the recent highs, keep it tight. And your target, you're risking you short here. You stop out about 3.5% above if you go that high. If you keep that tight stop and you're looking to make about 27%, probably plus. I think, when we hit the recession, we're going to go, I don't have it marked up, but probably a lot lower. I think before all said and done, the retail stocks will come back down here about a 51% drop on XRT. All right, I'm going to wrap it here, and we'll just keep that for the video for now. If you want any individual names or anything in this sector, you want a chart marked up, let me know. But consider those, all potential trade ideas for you right now. And I'll hunt and try to find out see if I can find some more longs, particularly in the commodity arena, but also look for equities for you. This has been Randy Finney with Right Side of the Chart. Have a great day.